There is something happening right now in the gold and silver markets that almost nobody is talking about in plain English. And if you own physical bullion, whether that's gold coins, silver bars, or any precious metal sitting in a safe, a vault, or a drawer somewhere in your home, you need to hear this before the window closes completely. This is not fear-mongering. This is not another one of those videos designed to make you panic sell or panic buy. What I'm going to walk you through today is a very specific set of conditions. Market conditions, geopolitical conditions, institutional behavior patterns, that in the entire recorded history of gold and silver markets has only lined up like this a handful of times. And every single time it's lined up like this, the people who paid attention walked away with their wealth intact. The people who ignored it didn't. So let's start with what's actually happening, because the surface-level story you're getting from mainstream financial media is missing about 70% of what matters. If you've been watching precious metals at all, you've noticed the extraordinary run gold and silver have already had. Gold has more than doubled from its post-COVID lows. Silver, at certain points in this cycle, has done even more than that, posting year-over-year gains that would look absurd if you'd predicted them 5 years ago. The financial press covered those moves, sure. They showed you the price charts. But what they didn't explain, what they almost never explain, is the underlying architecture that caused those moves. Because once you understand that architecture, you realize we're not at the end of this story. We might be at the end of the beginning. Here's the thing about gold and silver that separates them from every other asset class you've ever heard of. Stocks, bonds, real estate. Those are all claims on future productivity. When you buy a share of stock, you're buying a tiny claim on a company's future earnings. When you buy a bond, you're lending money and hoping you get paid back. Gold doesn't work like that. Gold doesn't make a promise. It doesn't need one. Gold is the only asset that has been recognized as money in every civilization on every continent across every recorded era of human history, without exception. That's not a coincidence. That's not tradition. That's the result of thousands of years of trial and error, of empires rising and collapsing, of currencies being created and destroyed, and one constant remaining standing through all of it. Now, why does any of that matter for the warning I'm issuing today? Because we are living through the most significant realignment of the global monetary order since 1971. And if you own bullion and you don't understand what that realignment means for your holdings so specifically, you are flying blind at a very dangerous altitude. Let me take you back to August 15th, 1971. President Nixon went on television and told the American people that the United States was temporarily suspending the convertibility of the dollar to gold. Temporarily. That temporary measure just celebrated its 55th anniversary. What happened in the years following 1971 was a slow-motion monetary experiment that the entire world became a test subject in, whether they agreed to it or not. The dollar became what economists call a fiat currency, meaning it's backed by nothing but the faith and credit of the United States government. And for decades, that was enough, because the U.S. economy was the dominant force on the planet. The dollar was the world's reserve currency, and everybody needed dollars to buy oil, to conduct international trade, to settle debts. That system is now cracking. Not crumbling, not yet, but cracking. And the cracks are spreading faster than most people realize. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding coalition of allied economies have been building a parallel financial infrastructure for years now. Alternative payment systems, currency swap agreements that bypass the dollar entirely, trade frameworks that settle in local currencies, or in some cases, in commodities directly. And underneath all of this, a quiet but unmistakable accumulation of physical gold at the central bank level that has no modern precedent. This is where the warning gets very specific and very serious. Central banks around the world have been buying gold at a pace that dwarfs anything we've seen in the last 50 years. Not just the BRICS central banks either. Countries you wouldn't expect, nations in Eastern Europe, Southeast Asia, the Middle East, have been steadily moving reserves out of U.S. Treasury bonds and into gold bars stored in their own vaults on their own soil. The message that sends is unambiguous to anyone paying attention. They are hedging against a world in which the dollar no longer plays the role it has played since Bretton Woods. They are positioning for a monetary reset, and they are doing it quietly, methodically, with the kind of patience that only institutions thinking in decades rather than quarters can muster. Now here's the part that directly affects you as someone who owns physical bullion. Check the description for the free guide I put together that reveals the savings and protection strategies that thousands of American retirees are already using to safeguard their hard-earned wealth. It's completely free. It's in the description. Check it out. I'll be here when you get back. When central banks accumulate gold at this scale, they don't announce it loudly. They do it quietly, over months and years, in tranches that are designed to not move the market against them. By the time the general public hears about it, the institutional positioning is already done. By the time retail investors start asking questions, the smart money is already sitting in the answers. This is the pattern. It has been the pattern for a century. And it is happening again right now at a scale and speed that is genuinely unprecedented. But here is where the story gets deeper, and this is the part that almost nobody is explaining clearly. There are two gold markets running simultaneously, and they are operating on completely different principles. And at some point, and this is the warning, those two markets are going to have a very public and very violent collision. The first market is the physical market. This is actual gold and silver, refined, assayed, stamped, stored. Real metal you can hold in your hand. When you buy a gold coin or a silver bar, you are participating in this market. The supply in this market is constrained. You can't create more gold by printing it. You can't reverse split your silver. The amount of gold that has ever been mined in all of human history, if you melted it all together, would form a cube roughly 70 feet on each side. That's it. That's all there is. New mining adds to that supply at a pace of roughly 1.5% to 2% per year, barely keeping up with population growth, let alone surging investment demand. The second market is the paper market. This is gold and silver futures contracts, exchange-traded products, unallocated accounts, derivatives, financial instruments that give the holder exposure to the price of gold or silver without actually involving physical metal. And here's the number that should make every bullion owner sit up straight. The ratio of paper gold claims to actual physical gold that could be delivered is extraordinary. Estimates vary, but we are talking about dozens, sometimes hundreds of paper claims for every single ounce of physical metal sitting in the vaults backing those claims. This works fine until it doesn't. The history of paper precious metals markets is littered with moments when the gap between paper claims and physical reality got exposed in ways that were catastrophic for the people on the wrong side of the trade. The silver squeeze of 1980, when the Hunt brothers cornered the physical silver market and sent prices to levels that, adjusted for today's dollars, we are only just now approaching again. The London gold pool collapse in the late 1960s, when central banks tried to suppress the gold price through coordinated selling and ultimately had to abandon the effort because the physical demand overwhelmed every suppression mechanism they deployed. These are not ancient footnotes. These are the template for what happens when the paper market and the physical market are forced to reconcile. And right now, the physical market is telling a very different story than the paper market is allowed to tell. Consider what has been happening at the major delivery exchanges. Reports of extended delivery timelines. Reports of premiums on physical metal that diverge significantly from the so-called spot price you see quoted on financial websites. Reports of specific bar sizes and denominations going out of stock across major dealers for the first time in years. These are not normal market conditions. These are the early symptoms of a market that is being stretched between two realities. The reality of what the paper price says gold and silver are worth, and the reality of what real buyers are willing to pay to actually hold physical metal in their hands. Now, if you're a bullion owner, this creates a very specific opportunity and a very specific risk at the same time. And this is the core of the warning. The opportunity. If you already hold physical metal and you've been sitting on it patiently, watching the paper market churn up and down, wondering whether the thesis has played out, it hasn't. The conditions that drove this bull market are not just intact, they are intensifying. The de-dollarization trend is accelerating. Government debt levels in virtually every major economy are at levels that historically have been resolved through one mechanism and one mechanism only: inflation, not austerity, not budget surpluses. Inflation, a deliberate erosion of the real value of debt through currency debasement. And gold and silver are the two most time-tested, most historically reliable hedges against exactly that outcome. Let me tell you about a moment in the early 1970s that I think about a lot. When I look at the current situation, there was a generation of investors, mostly older Americans who had lived through the Depression, who had seen what government interference in monetary markets looked like up close, who held gold, not in IRAs, not through ETFs, just physical metal, because they remembered what had happened in 1933 when Franklin Roosevelt signed Executive Order 6102 and effectively forced American citizens to turn in their gold to the Federal Reserve at a fixed price, after which he immediately revalued gold upward by 70%. The people who complied with that order were impoverished by it in real terms. The story of that era is a case study in why institutional rules about money can change, and why the people holding the physical asset are the ones who ultimately have something to negotiate with. By the early 1970s, those same Depression-era investors who had quietly maintained gold holdings watched the Bretton Woods system collapse, watched Nixon close the gold window, watched the gold price soar from $35 an ounce. The fixed price it had been held at for decades by government fiat to over $800 an ounce within a decade. That's not a return. That's a monetary reset. And the people who owned the physical gold through that period didn't just preserve their wealth. They watched their neighbors, the ones who had faithfully held dollars and treasury bonds, get quietly wiped out by inflation while the gold holders barely noticed. We are setting up for a version of that story again. The mechanism is different. The actors are different. The specific catalysts will be different. But the underlying dynamic, too much debt, a debased currency, geopolitical upheaval pushing nations to seek alternative monetary anchors, and gold and silver acting as the gravitational center that everything eventually has to orbit back toward. That dynamic is the same. If you're approaching retirement, or if you're already in retirement, and you have significant assets in traditional paper accounts, whether that's a 401k, an IRA, stocks, bonds, let me be direct with you for just a moment. The conventional financial planning framework that you were probably given, diversify across stocks and bonds, hold a cash cushion, rebalance annually, was designed for a world where the dollar was stable, where interest rates behaved predictably, where government debt was manageable. That world is changing fast. The diversification model that worked for the last 40 years may not be the right model for the next 10. This is why a growing number of retirement savers, particularly people with $100,000 or more in retirement accounts, are exploring the mechanics of gold IRAs, not as a way to chase gains, not as speculation, as insurance. The same way a homeowner buys fire insurance not because they expect their house to burn down, but because the downside of being wrong is too catastrophic to ignore. A properly structured gold IRA lets you hold physical gold and silver inside a retirement account with the same tax advantages you're used to, backed by real metal stored in an IRS-approved depository. If you're in that category and you haven't looked at this seriously, now is the time. Not because I'm telling you to, but because the people managing the largest pools of capital in the world are already positioned exactly this way. And they didn't get there by waiting for everyone else to figure it out first. The link in the description has everything you need to understand how it works, what it costs, and whether your situation qualifies. Now let me bring this back to the core warning for bullion owners specifically, because I don't want to leave this thread unresolved. You own physical metal. That puts you in a category that a very small percentage of the general public occupies. According to most surveys, fewer than 10% of Americans own any physical precious metals at all. You are already ahead of the curve in a meaningful way. But owning bullion and understanding what you own are two different things. And the warning I'm issuing is about the second part. Here is what the final warning means in practical terms. The paper gold and silver markets have been able to contain price movements through the use of futures positions, short selling, and the general assumption that most contract holders will never demand physical delivery. That assumption is being tested more aggressively right now than at any point in recent memory. As central banks withdraw physical metal from the global float, buying bars and shipping them home, taking them permanently off the market, the cushion that allows the paper markets to function the way they've been functioning gets thinner. When that cushion gets thin enough, the paper price and the physical price will diverge in a way that will be unmistakable and irreversible. The paper price will have to chase the physical price upward to the point where the gap closes. And that closing of the gap is historically violent and historically fast. There's also a geopolitical dimension that is accelerating the timeline. Trade tensions between major economic blocs, the United States, China, the European Union, have introduced a new level of uncertainty into global supply chains that extends to commodities, including metals. When global trade becomes less predictable, when tariff regimes can shift dramatically on short notice, the premium on holding real, tangible, universally fungible assets goes up. Not as a theory, as a practical matter for large institutions that can no longer count on seamless cross-border transactions. Think about what it means for a large sovereign wealth fund or a major pension manager to suddenly find their assets subject to geopolitical friction they didn't model for. Where do you go when the dollar-denominated financial system feels unsafe, but you don't want to bet on any specific alternative currency? You go where every institution throughout history has gone in moments of genuine monetary uncertainty. You go to gold, and then consider the supply picture more carefully, because this is perhaps the most underappreciated part of the entire bull case. Gold mining is a capital-intensive, long-duration business. From the moment a new deposit is discovered to the moment the first ounce comes out of the ground is typically a decade or more. The mining industry went through a period of severe underinvestment, following the last major precious metals bull market that ended around 2011. Years when gold prices were depressed and mine development projects were shelved or canceled entirely. That underinvestment in capital expenditure 10 years ago translates directly into constrained supply growth today. The pipeline of new major gold projects coming online in the next several years is thin, historically thin, at exactly the moment when demand is accelerating from multiple directions. Simultaneously, silver's supply picture is even more complicated because silver isn't just a monetary metal. It's an industrial metal, a critical one, with applications in solar panel manufacturing, electric vehicle components, medical devices, water purification, and advanced electronics that are only growing in scale. Global solar installation programs alone are creating industrial silver demand at a rate that is structurally altering the silver supply-demand balance. This is not speculation about future demand. The contracts are signed. The panels are being built. The silver is being consumed permanently in ways that remove it from the investable supply forever. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has historically moved toward lower values during bull markets in precious metals, meaning silver tends to outperform gold on a percentage basis when both metals are running. The current ratio, measured against its historical mean, suggests silver has significant catching up to do relative to gold even after the extraordinary moves we've already seen. This is not a novel observation. Experienced metals investors watch the ratio closely as a tool for positioning, but the degree of potential reversion is striking by any historical measure. Now, here is the piece of this that I want you to sit with, because it ties the whole thing together. The question isn't whether gold and silver go higher from here. The macro forces driving this market, debt monetization, de-dollarization, physical supply constraints, industrial demand for silver, institutional repositioning away from dollar assets, those are structural, not cyclical. They don't go away because the stock market has a good quarter or because some central bank makes a dovish statement about interest rates. They are baked into the global monetary architecture for the foreseeable future. The question is whether the specific period we are in right now, this window, represents the last genuine opportunity to position in physical metal at prices that will look absurdly cheap in retrospect, the same way the 1970s gold buyers who held through to 1980 looked brilliant, the same way the 2008 buyers who held through 2011 looked brilliant, or whether the window was already closing. Every significant bull market in gold and silver has had a phase structure. There's the accumulation phase, where informed institutional buyers quietly build positions. There's the awareness phase, where the price moves start attracting attention and more investors begin to understand what's happening. And then there's the mania phase, when gold and silver become dinner table conversation, when mainstream financial advisors start recommending them, when the people who got in early start getting calls from their friends asking how to buy. We are transitioning out of the accumulation phase and into the awareness phase. The mania phase is what comes after. That is the final warning, not a warning that something catastrophic is about to happen to your bullion. A warning that the moment we're owning it felt contrarian, felt lonely, felt like you were the only person in the room who understood why it mattered. That moment is ending. The rest of the room is starting to catch on, and historically, by the time the rest of the room is fully caught on, the easy, quiet accumulation is over. If you've been sitting on physical metal, this is not the time to reconsider your thesis. The thesis has never been stronger. If anything, revisit whether your position size reflects the scale of what is unfolding. If you've been watching from the sidelines, trying to decide whether to add physical to your holdings, understand that the conditions that once made entry straightforward, available inventory, near spot pricing, easy delivery, are not guaranteed to remain as they are. Because here's the thing about physical gold and silver that paper assets can never replicate. At some point, there isn't any more to buy at any price. The vault goes empty. The coin shop posts sold out. The online dealer has a 6-month wait list. That's not a hypothetical. That happened in 2020. It happened in 2008. It has happened in every major monetary stress event in modern history. And in every single one of those events, the people who already owned physical metal were in an entirely different position than the people scrambling to buy it at any price. The warning is this: the scramble may be closer than most people think. Now, for everyone who has watched this far, and if you've made it to this point, you're clearly the kind of person who takes this seriously. I want to make you an offer that I don't make publicly very often. The guide in the description is free. Anyone can grab it. But for American retirees specifically, people who have $100,000 or more sitting in any retirement account, there's an additional step available to you that I want you to know about. If you reach out through the link in the description and mention that you watched this video to the end, you'll be eligible for a complimentary one-on-one educational web conference. No sales pressure, no obligation. Just a private, uninterrupted session where you can ask every question you've had about gold IRAs, about physical metal storage, about how to evaluate your current exposure and whether it matches the risk environment we're actually living in. This is not something I offer to everyone. It's specifically for people who have accumulated real retirement savings and want a thoughtful, informed conversation about protecting it, not a sales pitch.